If you are a European investor and you've ever watched American YouTube content about ETFs, you've been getting advice that doesn't fully apply to you. Some of it is irrelevant, some of it is structurally impossible to follow, and some of it would actually hurt your returns if you tried to copy it directly. Today, I'm going to explain what's actually different about ETFs investing in Europe, why the rules are not what you've seen, and what you need to know to make smart decisions if you live anywhere on this continent. Quick context if you are new here. I'm Ivan. I've spent 23 years in finance, most recently 16 years as a board member of a development bank in Eastern Europe, where I negotiated programs with institutions like the World Bank, European Investment Bank, and UNDP, and personally appraised over 10,000 financing projects. I've also been investing my own money across ETFs, real estate, crypto, and securities for over 2 decades. That's the lens I bring to this channel. 3 things that are fundamentally different for European investors compared to Americans. First, and this surprises a lot of people, you can't actually buy most American ETFs even if you wanted to. Second, the tax treatment of dividends works completely different. Third, the European ETF framework called UCITS gives you options that Americans simply don't have. Let me walk through each of these. Let's start with the most basic surprise. If you live in the European Union, the UK or most of Europe, and you go to your broker and try to buy SPY, for example, the famous S&P 500 ETF, you'll get a rejection. The order will not go through. The reason is a regulation called PRIIPs, Packaged Retail Investment Products. It came into force in 2018 and applies to anyone selling investment products to EU retail investors. Under PRIIPs, every investment product must come with a standardized document called a Key Information Document, or KID. It's a short summary of risks, costs, and characteristics. Most US domiciled ETFs, including the giants like SPY, VTI, VOO, and QQQ, don't produce KIDs in the required format because they are designed for the US market. So under EU regulations, your broker is not allowed to sell them to you as a retail investor. This is not a tax thing. It's not a fee thing. It's a regulatory access thing. The ETFs you've seen recommended on Bogleheads or in American Finance YouTube simply aren't available to you. There are some workarounds: getting classified as a professional investor, buying options on US ETFs using derivatives. But for the average European retail investor, those aren't realistic bets. You play by the European rules. Quick note: if you live in a non-EU European country, Switzerland, part of the Balkans, the UK, or some others, you may have more access to US ETFs through your broker, but you'll pay a US withholding tax of 30% on dividends, which is steeper than what the EU framework allows. Even when US ETFs are accessible to you, the UCITS route we'll discuss in a moment is usually more efficient, so the rest of this video is still useful to you. The good news is that Europe has its own ETF ecosystem that's just as functional. It's called UCITS. UCITS stands for Undertaking for Collective Investment in Transferable Securities. It is the EU's regulatory framework for retail investment funds. ETFs that comply with UCITS rules can be sold across all member states. In practice, UCITS ETFs look and function exactly like US ETFs. They track the same indices. They are often issued by the same companies: Vanguard, iShares, which is BlackRock, Xtrackers, Amundi, State Street Spider. Performance is essentially identical to the US version of the same fund. Let me give you some concrete examples. If an American investor wants exposure to the S&P 500, they buy SPY or VOO. The European equivalent is the iShares Core S&P 500 UCITS ETF, ticker SXR8 or CSET. SPX, depending on which European exchange you buy it on. So same index, same exposure, comparable fees. If an American wants global stocks, they buy VT. That's the single ETF that holds stocks from companies all around the world. The European equivalent is the Vanguard FTSE All-World UCITS ETF. The ticker is VWCE for the accumulating version, or VWRL for the distributing version. I'll explain that distinction in a moment. So, when American content tells you to buy SPY, mentally translate that to buy the UCITS equivalent of an S&P 500 ETF. That's CSPX or SXR8 or any similar Irish-Domiciled S&P 500 tracker. The bigger issuers are largely the same: Vanguard, BlackRock, State Street, Xtrackers, Amundi. The TERs, that's total expense ratio, basically the annual fee fund charges, expressed as a small percentage of your investment, are competitive. You don't lose anything functional by being in Europe. You just use the European version of the same product. Here is something most beginner ETF guides skip, but it is important. Where your ETF is domiciled charges how much tax it pays internally on dividends. Most UCITS ETFs are domiciled in one of two places: Ireland or Luxembourg. You can tell which by looking at the ETF's ISIN code. ISIN stands for International Securities Identification Number. It's a unique 12-character code that identifies every fund. Every broker shows it. If it starts with IE, it's Irish-Domiciled. If it starts with LU, it's Luxembourg-Domiciled, obviously. What does this matter? Because of tax treaties, the US imposes a withholding tax on dividends paid to foreign investors. Ireland has a favorable tax treaty with the US that reduces this withholding to 15%. Luxembourg's treaty is less favorable. Let me explain MSCI quickly. That's Morgan Stanley Capital International, a firm that creates major stock indices. Their MSCI World Index, for example, tracks companies across most development markets. So when I say MSCI World ETF, that's a fund tracking that specific index. Anyway, for an ETF that holds US stocks, which include any S&P 500 ETF, any MSCI World ETF, any total US market ETF, a 15 percentage point difference in withholding tax compounds significantly over decade. This is why almost all UCITS ETFs that hold US stocks are Irish-Domiciled. Vanguard FTSE All-World VWCE is Irish. iShares Core S&P 500 CSPX is also Irish. iShares Core MSCI World IWDA, Irish. The major issuers picked Ireland deliberately to optimize tax efficiency for their European investors. So, practical takeaway: when choosing between two similar UCITS ETFs, prefer the Irish domiciled one if both options exist. The ISIN starts with IE for Ireland. This is not visible on the headline expense ratio. The TER is the same. But the net return after dividend withholding tax is meaningfully different over a long investment horizon. It's quietly built into your performance. One more big difference, and I'll keep this section short because I'll have a separate video coming on this specifically. In the US, all ETFs essentially pay out dividends periodically to your brokerage account, most quarterly, some monthly, distributing. You choose what to do with them. In Europe, UCITS ETFs come in two versions: distributing, that pays dividend to your account, similar to the US, or accumulating, reinvests dividends automatically inside the fund, no payout. You can tell which is which by the ticker suffix on the full fund name. For example, Vanguard FTSE All World has two versions. VWCE is the accumulating version. VWRL is the distributing version. Same underlying portfolio, different treatment of dividends. For most European investors in the wealth building phase, meaning you are saving and growing your portfolio, not living off it, the accumulating version is generally more efficient. You avoid the friction of reinvesting dividends yourself, and depending on your country's tax rules, you may also defer some tax liability. I'll deep dive into the accumulating versus distributing decision in the next video. For now, you just know that this option exists, and it doesn't exist in the US. Last topic. Where do European investors actually open accounts to buy these ETFs? Several brokers work for retail investors across most European countries. Each has different country-specific availability, so check whether they accept residents of your specific country. The main options most people use, obviously Interactive Brokers, the most international, accepts residents of most countries, including some outside of the EU. Slightly steeper learning curve, but the most flexible. Trading 212 and Trade Republic. Newer commission-free brokers, popular in many EU countries, similar interface, but check country availability before you sign up. The Giro, for example, Netherlands-based broker, broadly available across the EU, low fees, decent interface. Saxo Bank, Danish-based, more traditional, higher minimums, but very robust. For non-EU residents, Switzerland, the UK, the Balkans, parts of the Eastern Europe, your options are unfortunately a bit narrower. Some brokers accept you, others don't, depending on a country. Check before opening an account. Interactive Brokers is probably your best bet. They accept residents from most countries, including most non-EU European ones. One consistent piece of advice across all these options: open your investment accounts separately from your retail bank. Your bank wants you to use their in-house investment products, which are almost always more expensive than buying UCITS ETFs directly. Keep the bank for the current account and deposits. Use a dedicated low-cost broker for investing. To summarize, what's structurally different about ETFs for European investors? 1. You can't buy US ETFs as European retail investor. You buy UCITS ETFs instead, which are the European regulated equivalent. 2. The products are functionally similar. Same issuers, same indices, often the same underlying portfolio, just compliant with EU rules. 3. Domicile matters. Prefer Irish-Domiciled ETFs for funds holding US stocks. The dividend withholding tax efficiency is real. 4. You have the accumulating versus distributing choice, which Americans don't. Accumulating is usually better for wealth building. 5. Use a low-cost broker separate from your bank. Interactive Brokers, Trade Republic, the Giro, Trading 212, depending on what's available where you live. In the next video, I'm going to go deeper on accumulating versus distributing decision, when each makes sense and why most Europeans should default to accumulating, but not always. If you found this useful, please subscribe so you can catch the next one, and drop a comment which UCITS ETF you are currently considering. I read everyone. I'm Ivan, welcome to the Banker's Notes.